The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. I repeat, the MPC unanimously decided to reduce the policy rate by 25 basis points from 6.5% to 6.25%. Consequently, the standing deposit facility, SDF, the SDF rate shall be at 6.0%, and the marginal standing facility rate, also called the MCF rate, and the bank rate shall be 6.5%.
RBI's Monetary Policy Committee unanimously decides to cut the repo rate for the first time in 5 years by 25 basis point from 6.5 to 6.25%, and standing deposit facility rate shall be at 6.0%. Marginal standing facility rate and bank rate shall be at 6.5%. From the above news, we can discuss what is a monetary policy committee is, what is an inflation is, what is a repo rate is, what is a standing deposit facility is, and what is a marginal standing facility is. Monetary Policy Committee is responsible for fixing benchmark interest rate like repo rate, reverse repo rate, marginal standing facility, bank rate, cash reserve ratio, statutory liquidity ratio, open market operations, etc. It consists of 6 members, 3 from RBI and 3 from the government. The government of RBI is the head of the committee. It should meet at least 4 times a year when the vote ties governor as a casting vote. That is, his vote can decide the result. What is an inflation? Inflation is increase or upward movement in the general level of prices of goods and services. It is calculated over the corresponding period, that is week or a month or a year. Inflation target is 4 plus or minus 2, that is Monetary Policy Committee fixes the inflation target between 4 to 6%. Repo rate is decreased by the RBI so that the commercial banks borrow more from RBI at lesser interest rate at 6.25%. Commercial banks will be left with more liquidity to lend to people. This will increase growth and spur economy, and people will have more liquidity in their hands to spend, which will further increases the GDP growth. What is an repo rate is? It is a rate at which commercial banks, both public and private sector, borrows from RBI by mortgaging their government securities. If repo rate is increased, the banks will have lesser to lend to people, so people will borrow less, which will further reduce the inflation. If the repo rate is decreased, the banks will borrow more and banks will lend more to people, and people will be left with more liquidity to spend, thus increasing inflation and spur growth and economy. What is a standing deposit facilities? It is a new money supply facility, that is liquidity adjustment facility. Under this facility, RBI receives deposit from banks without any collateral. Its rate is fixed at 25 basis point less than the repo rate. That is, if repo rate is 6.25%, then standing deposit facility rate is 6.0%. Its aim is to observe the excess money supply from the market. What is an marginal standing facilities? It is a loan facility given by the RBI to bank against their government securities, treasury bills, etc. It is a loan for overnight, that is 1 day. Currently, the marginal standing facility stands at 6.5%. Repo rate stands at 6.25%. Standing deposit facility rate stands at 6.0%. Reverse repo rate stands at 3.35%. Thanks for watching this video.